Hey guys, it's Max. Thanks for joining my channel. Appreciate you all being here. Today's video is called SBAR and XV. New ETFs, two new kids on the block. I'm going to take a look at them. They're option strategy ETFs. We'll take a look at them. All right, like I said, thanks for tuning in the covered caller. My name's Max. I like to unpack option strategy ETFs and really liquid alternative ETFs. When it comes to liquid alts, it doesn't get a whole lot more liquid and a whole lot more alty than Simplify. The Simplify Barrier Income ETF, SBAR, is the ticker, launched on a few days ago. And right now it has 28 million under management. They also launched a related fund called XV. It has around the same amount of money under management. They're both brand new, but they're both option related. When I saw the symbol for XV, I was thinking it was going to be related, hoping it was going to be related to VIX somehow, but it isn't. It's still a good fund though. Okay, so SBAR, that stands for Simplify's Barrier Option Strategy. So what's a barrier option? So we're familiar with selling puts on this channel. We talk about it all the time. So let's talk about barrier options. So SBAR's core strategy is barrier options. So unlike the standard put, a barrier option features a barrier price level that must be breached for the option to activate. SBAR sells something called a knock-in put, down and out puts with a 30% barrier, meaning the option only triggers, and they also do this on a basket of stocks. But it only triggers, the option only becomes, they have to perform or make good on it only if the worst performing out of a basket of equity indexes of Russell, NASDAQ, and S&P, one of those finishes the year down under 3%. But if anything else holds, the fund keeps just gets to keep the income. Well, you always get to keep the income when you sell options. You get an income up front when you do this, just like selling any option, and you get to keep that. But if it doesn't go down 30%, the fund just keeps the premium. So you could think of a barrier similar to a strike price. Simplify's website calls this contingent downside exposure, allowing investors to quantify the risk up front. And then the worst of feature ties SBAR's risk to the weakest performing ETF out of Russell, NASDAQ, and S&P. Now this boosts yield, but it does add correlation risk. And this is according to their own literature. So SBAR, they use a laddered portfolio of these barrier options, and they're trying to smooth out path dependency. I believe they have 4 options on at a time. They ladder quarterly. All right, now let's look. Okay, let's look at their own media here. I'm going to upload this PDF in case you guys want to study it, and I would recommend you do study it because they explain in here that they make a case for barrier options, and they're making the case that the barrier option is a great alternative to structured notes. Banks used to issue structured notes instead of doing covered calls and selling covered calls in the open market or doing some type of strategy. They would go get a bank to issue a note and just give the payout of whatever the strategy is. Well, that didn't have a lot of transparency. People don't understand how those agreements work between institutions, the swaps and stuff. So this is, according to their own literature, is trying to bring this into the public markets. And this is an alternative. They're just it's an alternative structure note. So Simplify Barrier ETF now provide more operational efficient alternative to traditional structure notes by eliminating key constraints that often burden investors. So ETFs have continuous liquidity, no lockup periods. Investors can enter and exit positions with ease. In the old days, you couldn't do that with structure notes. The ETF wrapper has been great for a lot of more sophisticated strategies. Now, here's what I wanted to show you guys, this worst of feature. So it says here, to enhance monthly income, SBAR and XV, this other one we're going to talk about, employ a barrier put option with the worst of feature. Selling a worst of, deep out of the money barrier put option on a diversified basket of reference asset allows for a collection of higher premiums while maintaining disciplined risk framework. This approach capitalizes on the low probability of the option being exercised, as it remains significantly out of the money. By structuring these options with typical 12-month duration, the strategy seeks to maximize premium retention while providing contingent downside exposure, whatever that means. And we believe this will ultimately deliver attractive income streams for investor. It says SBAR incorporates a 30% barrier put option designed to provide contingent downside exposure while enhancing income. Empirical analysis of rolling 12-month periods suggests that the barrier option level has been breached. I would say only been breached, but has been breached approximately 6% of the time, leading to drawdowns. Notably, these breaches were predominantly observed during periods of extreme market stress, such as technology bubble or 2008, 2009 global financial crisis. And of course, we would expect this. Everything that I've read so far makes a barrier option sound pretty much similar to a regular option. It's subject to the same. It's subject to the same market disruptions. And whenever you have volatility blow up, like we did in the great financial crisis, it affects these types of strategies. But anyway, it still says, according to them, these options would have only gone in the money 6% of the time. So what we're going to do is we're going to back test it, and we're going to check them out on it. Here's a rolling 12-month return, and it goes back to 2001. So I guess anywhere where it's under where it says 70, where 70 would be times when the market would drop that much like I say, I'm going to upload this PDF. This is a PDF. I'm going to upload this. You guys feel free to go get this. Read all about this callability feature. This is a feature that makes these a little bit different from vanilla puts. But basically, I think of the barrier very similar to a strike price. Now, on XV, here's the thing. They don't sell as many options. They don't do as many barrier options. They only do as many barrier options as they need to pay 15%. So that makes me think SBAR is going to pay I think will probably pay more than 15%. That's what they're hoping. I bet it pays about twice that. I bet that's what they're aiming for. And I'll show you why I think that. But now XV is going to be a target fund just going for 15%. Now, this is interesting, outcome and scenario analysis. So let me just try to summarize this. See, down here, reference asset return over the life of the swap. Remember, there's a 30% barrier, or if you think of it as a put with a strike price 30% below the money. Okay, so what would happen? What would happen if the market dropped 33%? Well, in this case, the option goes into existence. It would knock in, and you would realize that entire loss. The fund would be down 33%. Now, the good news is whatever the fund sold the option for, the premium. So let's say it was 10%, then the fund would only be down 23%, but the market would be down 33%. But now, on the other hand, if the market just drops 28%, the option never goes into effect, and they just get to keep the premium. So they don't have any NAV loss, theoretically, with these type of options. They still receive the 10%. They always get the premium. So then in this case, they're up 10%, even though the market was down 28%. And then if the market's up 16%, kind of the same thing happens. They get the 10%, and that's all they get. Simplifies revolutionizing structured investing by seeking higher income, contingent risk, and greater operational efficiency, all within the transparent and flexible ETF framework. And so here's what they're saying. By eliminating bank credit risk, reducing compliance burdens, ensuring continuous liquidity, we believe our ETFs provide a superior alternative traditional structured notes. All right, so here's what I was doing some research. I looked at all that stuff they told us. I went back and I tested it, and came out pretty well. You can see the wins and losses. You do only lose 10% of the time or something. They said 6% of the time, a very small percentage of the time when you sell options that far with money. I went back 5 years on this, went back to 2020. You can see the equity curve, which is here in orange, is very smooth. You just make a little income, but even when the market pulls back, unless it pulls back really far. So that's a great back test. And right here we have 90% of the trades are winners. Average premium $5,000. So this trade could be put on for a $5,000 credit every time you put it on. And over the course of those 5 years, that part of it came to $155,000. That's the premium generation part of it. Anyway, so yeah, I tried to simulate it as best I could. Here's what I think. Here's basically what a barrier option, the risk reward looks like. What I did is I moved this down 30%, and I went out a year. So this is what it would look like if you did it with standard options, and it's similar. It's related, but in the option doesn't come into existence. In other words, you don't have to perform. You don't have to do anything. You don't have to, in other words, buy stock, which is what you have to perform when you sell a put. You don't have to perform unless the market drops more than 30%. So in this over the course of years, you could see the one standard deviation down is 20%. That would be, it's not out of the realm of possibility the market dropped 30% in a year, not at all. But this trade has about a 96% chance of profit. So this is the way I simulated the trade. I did this and I rolled it every quarter and just kind of kept a rolling, just kind of kept rolling exposure to this income source. Now it can't do the most recent, can't simulate anything within the past, within the past year, because we're using an option that's a year. I'm trying. This is late. Last time I did, but anyway. So it can't, it stopped simulating it in November. But in any event, I would be interested in a product that paid some type of yield. I don't know how much that's going to be yet based on these numbers. $155,000 over 5 years. It's really not 5 years though, because it cuts off. They'll call it 4 years. It's like $50,000 a year. It's like 10%. I mean, the way I did this. So this strategy, if you did this strategy, it would pay about 10%. You could pay about a 10% yield. But I'm in it more for the. I really like the way the equity curve looks on this. This is one of the best equity curves I've ever seen. In fact, this equity curve is better looking than my GOAT strategy. So anyway, maybe this is the new GOAT strategy. Look at the max drawdown, 7%. Whereas the market, if you just buy and held the market, the max drawdown was 25%. And that was that 2022 bear market, right? The orange line wasn't even phased by the bear market. It just kept grinding up. So yeah, this could be real interesting. Simplify has a lot of other interesting funds. So I wouldn't know why this might not be one. Also, Simplify is kind of, to me, Simplify, Granite Shares, Yield Max, Defiance, Round Hill. And I may be forgetting a couple, but those are the big liquid alt and option-based funds. Those are the big issuers. All right, guys. Well, let me know what you think about this fund. I think it's going to be interesting. It's only been out a few days, or they haven't paid a dividend, so we'll keep an eye on it. I'll probably put it on the buffer report, and we'll start looking at it. we'll start probably looking at both of them every day. All right, guys. Appreciate you all for being here. Have a great day.